Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market recap for the week of July 25th. We saw a really nice rally this week, and we've seen a couple of weeks of pretty nice price action, so let's dive into the charts and take a look at what we're seeing. Starting out with the S&P 500, we did get up to the 414.50 level, which is a key Fibonacci extension level that did look like it bounced off of that going into the close on Friday. So we'll see if we see a bit of a sell-off potentially starting the week off, or if we can push up higher above that Fibonacci extension level at the 414.50. If we do continue to see a sustained rally in the markets, I think the key area I'll be watching for over the next few days to few weeks would be getting back up to this 200-day moving average on the major indices. I think that would be potentially a logical conclusion on this bear market bounce, and if that's the case right now, the 200-day moving average is sitting at about 433 on the SPY, so anywhere between kind of 425 and 435, I would say, would likely be a potential top on the S&P 500 on this current rally if we can get that high. And then take a look at the NASDAQ. We actually got up to about 315, it looks like, on the triple Qs. We are coming up against a 50% retracement, which would put us at about 320, 321. The 200-day moving average is sitting currently at about 345. That 341.50 level looks though like that would probably be a potential convergence area where that 200-day might hit if this bear market bounce continues. So possibly 341.50 might be a possible top in the triple Qs before we roll over from there. And then take a look at the Dow Jones Industrial Averages. 200-day moving average is sitting at about 340 right now. We just got above 325.78, closed the week on 328.66 on the DIA, and again looking for that potential 200-day moving average for a potential top, which currently is at about the 340 level on the Dow Jones Industrial Averages. When we take a look at the Dow Jones Transportation Average Index, we had a break back above this 1.618 Fibonacci extension off the pre-COVID crash levels on the Dow Jones Transports, and so we closed back above those levels, which we've kind of been trading around in for quite some time, up until just the last few months, and so that's definitely a bit of a recovery in the Dow Jones Transports, and we do have this 50-week moving average to contend with, which is right around the 15,000 level, give or take, and if we can get above that, then we might continue to see a sustained rally in the transports. But the main thing that I'll be looking for on this chart, though, is just making sure we're above that 14,373 level, which is the Fibonacci extension. So if we're above that level and holding that, then it looks like there might be some trading opportunities developing in the transports. And then we look at our Russell 3000 chart. We actually got back above that center channel line, which was a pretty big development. We've kind of been chopping around. There's been multiple weeks where there's been attempts to get back above that center channel, and each time it's rejected off of that, going all the way back just even the last week, but we really had about 4 or 5 weeks in a row there where it tried to get above that level. This last week it actually succeeded and got above that center channel line. Now it's getting pretty close to the 100-week as well as the 50-week moving averages, so those will be the next two areas of resistance to watch for on the Russell 3000. And when we take a look at the Russell 1000, our large caps, we are fastly approaching reaching that 1.618 extension off of the pre-COVID highs right before the crash. That would be at about 231.15, and we're sitting at about 227 currently. So if we can get above those levels, I'd say that would be a pretty bullish development for large caps, as they have been doing fairly well over the last few weeks with this rally we've been seeing. And when we take a look at the small caps, Russell 2000, we've seen 2 weeks ago we got above the 200-week moving average. And this last week we had even a bigger move to the upside. Now we're above the 150-week moving average, and so small caps are actually looking pretty good, looking like they've got some nice momentum behind them. And so if we continue to see this rally continue, we'll probably be looking at a couple of key levels, potentially right around 197, 198, or about 204.50 for some potential tops on the Russell 2000. And then when we look at our growth versus value, we can continue to see that while value was the clear winner over growth since November of last year, that's been a bit of a reversal since towards probably the end of May, and now we're really starting to see growth outperform value, and that's continued last week as well. And so it looks like That trend will likely continue going forward, at least for a while, and we'll probably be looking for that to potentially either break out or resist up against that 50-week moving average, which will likely be right around that 1.66 level on our growth versus value chart. And then diving into the sectors, taking a look at what's outperformed and what has underperformed for the last couple of trading weeks. We saw some huge moves in clean energy and solar. Solar's up over almost 23%, clean energy up about 18.5%. We've seen some big moves out of natural gas and the XOP, oil and gas exploration. Big moves out of energy, steel, metals and mining. That's a big turnaround for the metals and mining space, as that was just getting beaten up for weeks on end. We've seen really just a lot of positive developments pretty much across all sectors. When we scroll down, the only sector that was in the red over the last 2 weeks was biotech, which that's a bit of a change because biotech was in a bit of a leadership role previous to this, but it's not a huge sell-off, so that could just be a pause in biotech before it heads higher. But we're really just seeing across the board a ton of positive space in the last couple of weeks, really across all sectors. But some of those ones we highlighted at the top are definitely some of the strongest leaders over the last few weeks. And then when we take a look at our U.S. oil chart, we kind of look like we might be trying to develop a bit of a floor sitting right around about $95 a barrel. We'll see if that holds. So that kind of be a key level that I'll continue to keep an eye on right now, is that $95 price action. We're above that right now, closed the week out at about $98 a barrel. And so we're somewhat bullish to neutral on the energy space right now. Obviously, it's done really well over the last couple of weeks, but we're not seeing a huge spike in oil prices quite yet. It's unclear whether we'll actually see that or not. There's been a lot of attempts by the Biden administration and others trying to figure out more oil supplies to keep oil prices down, and so we'll just have to keep an eye on that to see if we do see a big oil price spike. Obviously, if the barrel prices really go flying up to the upside, then typically those energy trades will follow. But we can also see energy perform okay, even if oil just kind of chops around sideways from here. So as long as we're sitting at $95 plus a barrel, I think we're fine, or at least above this 50-week moving average. I think we're still fine on the energy trades. And then when we look at our commodity charts, the CRB Index, we dropped down below into this bottom channel after that huge explosion to the upside back in February. So we're now back into this lower channel trading range, but still to the upside. We're still above the 50-week moving average. And so it looks like we might have put in a bit, at least a short-term bottom in commodity prices for the time being, and so we'll keep an eye on that. We'll see if it hits some resistance at the center channel and then ultimately just trades higher into this lower trading range as opposed to this higher channel. And so we'll get probably an answer on that development over the next week or two. And then when we take a look at our consumer discretionary versus consumer staples, we've seen a big trend change just in the last 2 weeks. We were pretty much heading straight down and to the right for multiple months, really all the way since November of last year. And then 2 weeks ago, we broke that down channel trend line. And then this last week, we actually came back down, retested it, and then shot back up pretty aggressively. And so far, that's a pretty good look to come back and retest a down channel trend line like that and then bounce off of it pretty aggressively. Decent chance we'll see that head higher and continue to see consumer discretionary outperform consumer staples, at least in the short term. And then when we look at the all-world ex-US chart, so this is the global markets minus the United States, we've seen a pretty strong move to the upside over the last couple of weeks after what looked like a pretty decent bottom being put in, at least in the short term on the all-world ex-US chart. But when we look at it on relative terms, taking a look at emerging markets divided by the S&P 500, it's actually down quite a bit this week. And so while the global markets did have a rally over the last couple of weeks, the rally was not as good as the United States markets were. And so it still is looking like the U.S. is the stronger place to be for the markets for the time being. And then we jump over to our high-yield corporate bond ETF. This thing was below the 75 level, which we talked about when the markets were really in some trouble, and then the markets were selling off below that 75 level, but now we're back above it and pretty strongly, and now we're heading back up to likely that 79.50 level, which we'll see if that'll act as resistance or if we can break through and head even potentially a little bit higher. But as long as we're above that 75 level, I think that's telling us that there's still potentially some legs in this rally that we're experiencing right now. And if we see a drop below that 75 level, once again, which I think we will, I think that'll be a warning sign that the markets are falling apart again. And then we look at things on a relative basis, taking a look at the high-yield corporate bonds in relation to our in relation to our traditional bonds. We are back into this range of the 0.73 to 0.77 range. Been there for the last about 3 weeks now after we fell down below that range. I think the next time the markets sell off, we'll likely see a fall back below that 0.73 level again on this chart, and that's why we keep a close eye on this one. I think it's a good indicator chart for the health of the markets, and as long as we're sitting above that 0.73 level, I think that the rally that we're seeing right now can continue for the time being. And then we also saw a huge development out of the metals markets. We talked about it in the sector review, but gold had a big move to the upside for the week. I mean, relative, gold doesn't move, super quick, but for gold's sake, it was a pretty decent move, moving from about 160 to 164, so about a 2.5% move on the week. And then we saw a much bigger move out of silver. We're wondering if silver was going to potentially sell off maybe down to 15 or 16 per ounce before it found the bottom, but it's really looking like it may have found the bottom here right around that 1650 level. Moved really strongly this week up to the upside, back up above 1870. We are coming up against this 200-week moving average, which could potentially act as resistance. But that was, either way, that's a really strong move out of silver. And that looks to me like it is potentially putting a bottom in on the silver price. And at least for now, we should probably expect at least sideways, if not upward movement in the silver prices going forward. And then we jump over to our US dollar chart, the DXY. We've seen the dollar roll over the last couple of weeks pretty nicely, and that has been one of the reasons why I think the market has been able to rally pretty nicely. Typically, a falling dollar is good for markets, and a rising dollar is bad for markets. And as long as we continue to see the dollar go down or chop around sideways, I think that'll be a good sign for some continued movements to the upside in the markets. If we start to see the dollar roll back over, back up to the upside as it's still in a long-term uptrend, then I think that'll be potentially at least a warning signal to keep an eye on the markets, as that could be a time where the markets could roll back over to the downside. And then when we take a look at our interest rates, our 2-year closed the week out at about 2.88%. Definitely down on the week. We've had about 2 pretty strong declines, 2 weeks in a row of declines in the 2-year. And then we jump over to the 10-year. We closed the week out at 2.65. Pretty big development here as we broke down below this 40-year trend line that we've been tracking for quite some time. And we also had a trend break off of this topping pattern to the downside. And so it's looking like we could potentially be seeing a top in rates, even though there's still talk of further rate increases. I think the markets and the bond markets are telling us something that we at least have a short-term top in rates for a while now, or it could very well just be the top in rates entirely for this particular cycle that we're in. And so, based on what I'm seeing, it started to make me interested in looking at some bond trades. And taking a look at our 30-year, we closed the week at about 3% on that one. So the 30-year is still sort of hanging in this range. I'd like to probably see that break below the 2.95% range, but we've already seen a breakdown in the 10-year. The 2 years starting to sell off a bit, and so we also, when we jump over to the IEF chart, this is our 7 to 10-year Treasury bond. This was a good enough looking chart that made me want to get in on a trade for this one, as we're seeing a inverse head and shoulders pattern and a clear breakout over the last couple of days. And so based on seeing the rates roll over in the markets, as well as seeing a clear breakout on a technical basis on the IEF, I went ahead and put a trade on the IEF. I did some call options going out a few months on these. You could also just go long on the bond itself. A little less risk that way, but if you want a little more upside, you can do it through some call options. And I think at a minimum, I think we could easily get back up to that 200-day moving average, and that's like conservative. I think there's a good chance we even go higher than there. I'm actually thinking that we might potentially get all the way back up to about 113 on the IEF. And so those are a couple of targets that I'm looking at, and I'm in on some bond trades currently, as I think the rates are starting to roll over now. And then when we take a look at our yield curve, this is just another great reminder that while things are looking really nice over the last couple of weeks, I think this is telling us that overall the markets are still in trouble, because we are sitting below that negative 0.22 level, which is a level we've only been under about 2 or 3 times, going all the way back into the 1980s. And in each of those times, we had a pretty severe correction in the markets. And so I think this is just a great reminder that while we potentially might have a nice sustained bear market bounce that could last for a few weeks, maybe even a month or two, we need to be cautious. And if we start to see the markets roll over, get defensive again, because this chart right here, I think, is telling us that we still have some more pain ahead of us in the long term. And then when we take a look at our VIX, more of a short-term indicator, we continue to see the VIX drop to levels that we haven't seen in quite some time. We haven't been this low on the VIX since April of this year, so that's definitely a bit of a development as far as our fear and volatility index goes, and I think there's a decent chance we'll get back down to 20. We'll see where we go from there, if that holds as support and if we head back higher, or if we maybe potentially get down below 20, which we haven't been below 20 on the VIX since late March, very early April. And so really, I think as long as the VIX is continuing to decline and we're not above 25, or especially not above 30, I think that's also a sign that we might potentially see some more out of this bear market rally that we're experiencing right now. And then we look at our put call ratio. We're just below normal levels, or just in normal levels, just below elevated levels. We're at 0.99 right now. Anything above 1 is elevated put buying protection. So there's still people, I think, being cautious in the markets, still keeping that protection on in the markets just to be safe. But we are kind of within a more normal range than we've kind of seen over the last few months as well. So that's looking pretty decent there. And we'll go ahead and close it out with a couple of crypto charts. Bitcoin's had some big moves. Probably the biggest news out of Bitcoin over the last week is we saw a major trend break. This is a down channel trend line where we had pretty much a descending wedge pattern for many months. This started out declining late March, early April, and has not been able to break this down channel trend line for the entire time up until July 28th. It looks like it was the day we broke out, and now we're kind of hanging out in this bullish bull flag pattern right now. And so we'll see if we can continue this rally to the upside, but I think the fact that we've broke this channel, and as long as we can stay above this down channel trend line now, I think that's a clear sign of a trend break in the crypto markets. If this rally continues, I wouldn't be surprised to see Bitcoin head back up to 30,000. There's a lot of resistance up there, and so that would probably be a logical place for it to stop. Potentially maybe go a little bit higher than there, but I think 30,000 would be a pretty reasonable bounce to expect, as long as we stay above this down channel trend line. And with that trend break, I think it's setting up a lot of great trade opportunities. We've called out a few of them in some of our short videos. But we'll also go over Ethereum here before we wrap it up and take a look at the Ethereum chart. We're in this one as well. Ethereum had a nice move to the upside. It's also kind of sitting in a very similar pattern as Bitcoin, kind of a nice little bull flag, bull pennant pattern right now. So if that continues to the upside and breaks from there, I'd be looking at some upside targets of about anywhere between 21.35 and 24.50 on Ethereum for some potential places to take profit in some Ethereum trades. And then make sure to tune in. We'll have some more shorts coming up as this bear market rally continues, hopefully, into the next few weeks. We'll continue to call out some short-term trade opportunities so we can hopefully make some money before the next leg down in this market. Make sure to download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto. It'll help you navigate these challenging markets. And make sure to like and share the video, and we'll see you next time.